Hello and welcome everybody. Welcome back to Sectors Made Simple, and today we have lots of current events to talk about. If you read our newsletter that came out yesterday morning, I mentioned that this week we will be covering what is going to be happening with earnings this week and what happened with Fitch, one of the big credit bureaus, last week. Unfortunately, or interestingly, today there was even more credit changes. So instead of talking about earnings, which I want to make sure I can cover earnings because I promised I would, there's not much to talk about. This week, there's less than 30 S&P 500 companies that are issuing earnings. They're not important. What is what's going on right now with bonds and debt securities. There is lots to talk about there, so I want to focus today's webinar entirely on that. We're going to talk about the big three credit bureaus for corporations and governments, what these corporate ratings are, why they're important, and how they've been changing, mostly for the worse, in the past week. So, without any further ado, let's get into what I have to cover with you all today. So, the goals for today's webinar is that we're going to look at a major event that shaped the market last week. This event was a report provided by the U.S. credit rating agency, Fitch. We'll cover what Fitch is and what the other major credit bureaus are, why they're important to the U.S. securities market, primarily debt securities and bonds, what that report included, how it impacted the market, and what happened today. Lots for us to go over, so let's start off quickly by talking a little bit about credit and lending. This shouldn't be a weird concept to talk about. When we think about credit, don't overcomplicate it. Think about your credit. Think about borrowing money to buy a car or a home. We're not going into some crazy things just yet. We're going to keep it simple. Credit and lending is just debt and borrowing. So this is extremely common. People like you, me, and Juan de los Palotes, we all want to buy nice things. Nice things are really expensive. Expensive nice things. Like homes and cars. When we want to buy a home or a car, we're not going to our bank, pulling out $800,000 and slapping it down on the table saying, all right, give me a house. No. We're putting down some money, but the rest of it we are borrowing from a bank or from a credit union. So this is not something that is only limited to consumers, people like you and me. It extends to businesses as well. Businesses need to fund their projects, their hiring, new construction, new research, expanding their companies. There's lots of reasons for companies to borrow money. Also, the government. We've talked in the past about bond markets and how there are corporate but also municipal bonds. These municipal bonds extend to city, state, and even nation-level borrowing. So, debt, borrowing money, credit, and lending, all of this extends all the way from us, all the way up to Uncle Sam and his big fat pocketbook. For every single loan, doesn't matter who you are, doesn't matter what your credit score is, there's a risk of not paying back that loan. This is a process known as defaulting. We'll talk a little bit more about defaulting later, but just to give you a decent idea so we can move forward. When you borrow money, you're going to have to pay little bits of that money back, called the principal, and you're going to have to pay interest as well. If you own a home or a mortgage, or you bought a car on credit, you make monthly payments towards that loan. Those monthly payments are a way of saying to the bank or the lender, hey, I haven't forgot about you. I'm doing my best to pay you back the hilarious amount of money that I borrowed. This is exactly what happens when anyone, regardless of how big or small they are, borrows money. What happens if you can't make those monthly payments? You default. For people like you and me or corporations, it's going bankrupt. But the reality of it is, the higher the risk in the loan, the more interest you will pay. Stocks are weird. There's no yes, there is high risk, high reward, but it's not something that we can easily slap a number onto. Bonds and debt securities are a different story. There is numbers that we can smack onto these different investments. And the more risky that investment is, the more interest and the more profit you can gain, as long as they don't default on it. And the reality is, it doesn't matter who you're borrowing from or who you're lending money to. Even Uncle Sam has a risk of defaulting. So we need a way of understanding what that risk is. Lenders, people that give money to others, they need a way of understanding that risk. That is where credit agencies or credit bureaus come in. These credit rating agencies, their job is to give us information about loans and other debt-based securities. When I say debt-based securities, by the way, what I mean with that is that loans are not the only type of borrowing that can happen. There are other types of securities, investments, that are based on debt. There's bonds and there's loans. Those are two of the big ones. The reality of it is you're not going to go to the stock market or you're not going to go to the bond market and loan money. There's not going to be some representative from Apple just sitting there hoping that you're going to throw them a 20. What happens is that they're going to issue bonds, treasury notes, whoever or whatever it is, they will have a standardized way of requesting money. Those standardized ways have how often they'll pay interest, how much interest they'll pay, when they pay back the full amount. There is a lot that goes into it, and if you're interested, we have lots of videos on bonds. But today, what we are focused on is the act of lending, not how bonds make us money. So let's keep things nice and simple. If we're going to borrow money, or if we're going to lend money, we need to know how much risk there is. So in simple terms, what's the chances that the person with the debt pays back that debt? For consumers, if we want to go to a bank and borrow money, if we want to open up a new credit card, if you want to get a car and get a loan for a car, chances are they're going to ask what your credit score is. Or they're going to pull your credit score from one of three major credit bureaus. It can be called agencies, bureaus, all the same thing. The three big ones for consumers are Experian, TransUnion, and Equifax. Those names hopefully should sound familiar to you, because anytime you've probably gone to lend or to borrow something, these names will probably come up. Now, these agencies monitor our personal credit. They know what our debt to income ratio is. They know how many credit cards we've opened. Bless you. They know if we own a house, how much money we owe on the house. They know everything. And if we don't pay our bills, if you don't pay your electricity bill, your electricity provider can contact these agencies, these bureaus, and tell them, hey, Jonathan didn't pay his bill last month. And your credit score will be negatively impacted. If you don't pay back your mortgage, one, they'll probably repossess the house, but two, they're also going to report that to the credit agencies, and your credit score will be affected. So these credit bureaus, their goal is to give lenders banks, whoever it is, car companies, your credit card companies, all of them. Give them an idea of how much risk you have. Credit scores can be anywhere from 0 to over 850. Good credit score depends on what you're looking for. But people will typically say excellent credit scores are 800 and above. The better your credit is, the higher your score is, the better your credit is. The better your credit is, the better chances you have of getting a better rate. Remember, the less risk you have, the less risk there is for the bank. So they don't need to charge you a bunch of extra risky things. They can just say, all right, we know you're good for the money. We're going to charge you the minimum that we can charge you. Typically, that is based on the federal fund rate, by the way. So if the federal fund rate is 0, for example, chances are if you have excellent credit and the loan you're looking to get isn't crazy, you're probably looking at around a 2.7% to 2.8% rate. If the federal fund rate is 1%, expect that to be 3.7 or 3.8%. If it is 5%, you're looking at about 8 to 9% at least. And that's if you have good credit. What I'm trying to say here is that when we want to borrow money for a loan, for a credit card, whatever it might be, the less risky we are, the better rates we'll get. Now, let's talk about corporate or municipal credit agencies. Just like we have Equifax, TransUnion, and Experian. Almost said Expedia, slightly. There are credit agencies that track credit and give credit scores to companies and governments. There are many domestic, so US-based, and international bureaus. The three that are 99% of the time looked at are Fitch, Standard & Poor's, and Moody's. The three of them are held as the gold standard. That's a kind of funny term given what we'll talk about in a minute here, but they are held as the three that you look at when you want to know the rating for a specific company or government. But instead of giving a credit score with a number, instead, we're taking things back to middle school and we're going with some good old grades. They grade all of these securities. The higher the grade, the lower the risk. Because there's less risk, there is less reward. That is how these debt markets work. Moody's, Standard & Poor's, Fitch, they will give a rating. If the rating is lower, the reward is higher because there is more risk. Even if you are perfect, there's still a risk. There's no such thing as a zero risk investment. So when we're looking at these bonds and debt securities, even if you have a perfect score, there is still always a risk. And the most interesting part about what we're talking about right now, when we're talking about lending money to companies or governments, if we're buying these securities, we are the lenders. We are lending money to Uncle Sam to go and spend how he sees fit. In exchange, we get some interest. And when the bond reaches maturity, we get the principal amount back. Because of this, because we are the ones lending the money, if you know your credit score, awesome. Most of these bureaus, unless you have some plan with Bank of America or whoever you bank with, that they give you your credit score whenever you want it, there are limits to how often for free you can pull your credit score information. Bonds, companies, and governments, these ratings are public because we are the investors. They need us to know, and we have a right to know what their ratings are. So, with that said, how are corporate bonds rated? Well, unfortunately, it's not like a credit score, where every company or bureau uses a scale of 0 to 850 plus. Instead, they all have their own grading scales. There are lots of grades, which we'll go into in a second, but if you don't care that much about it, think about it like this. Just like school, or I guess like college, there are two categories. You passed the class, you failed the class. That's it. For bonds and other debt securities, there are two different classes. Investment grade, these are the really, really good bonds. These are the low risk, but low interest rate securities. Most reputable companies that you think of, and most governments, are considered to be investment grade. I would really hope so, at least. Then below that, there are junk grade. These junk grade, high yield, there's many different terms for it. They are more speculative, so there's a little less certainty with if you're going to get your money back or not. There's higher risk, but because of that, there is higher reward. This is like going and trying to buy a house with a 500 credit score. If you get lucky and find someone that wants to lend you that money, you're going to be paying for it in interest rates. With that said, let me show you what the corporate and government bond rating scale is. Told you it's not as easy as a number. But let's break down what we're looking at here. Just like school, there are grades. Instead of it just being A, B, C, D, F, and having pluses and minuses on them, we also have letters. So we have AAA, then depending on who you look at, it will be, so for Moody's, for example, they do AAA, and then instead of AA+, they do AA1. Instead of AA, they do AA2, AA3, then A1, A2, A3, so on and so forth. The other guys, they do it a little bit more old-fashioned. A+, A, A-, but they use 3 letters. So you'll have AAA, then AA+, then AA, AA-, A+, A, A-, and so on. We see here, below triple B- or BAA3, we enter junk bond territory. Now, anything below BA1 or BB+ is considered to be junk grade. That doesn't mean that these are instantly things that will fail. Most bonds and most debt securities don't default. All that means is that there is more risk. The only time that you're getting into the actually defaulting territory is when you're getting into CC+, CC territory, and D territory. Then these guys aren't at risk of default, they are actively defaulting, and there is even an additional category that we'll talk about in a moment. Because I want to give you some examples of different ratings. Let's start off with some good companies. Microsoft has a AAA rating, or an AAA. It is only one of 2 S&P 500 companies that have perfect corporate ratings grades. I'm curious, which one do you think the other company is? Bonus points to whoever can guess what the other company is. So again, there are 2 companies. Apple, by the way, I'll give you a hint, used to have a perfect grade, was downgraded earlier this year. So now, again, there's only 2 companies that have perfect bond rating grades. Who do you think it is? Microsoft is one. Who's the other? In the meantime, we'll keep things moving forward here, and we'll move a peg down from Microsoft and talk about Amazon. Amazon has an AA- grade. I don't think we're worried about Amazon filing for bankruptcy anytime soon, but for many reasons, they do not have a perfect ratings scale, or a perfect ratings grade. Not even close to it. Remember, AAA, then below that we have AA+, then we have AA, AA-. So they are not even close to the top of this scale. They are here at the bottom of high grade. Romulo says Alphabet. Alphabet doesn't even have a perfect score. The other company that I was looking for is Johnson & Johnson. Johnson & Johnson is the other company that has a perfect corporate rating and is the one that has held that title the longest. Now you know. Let's move into some governments. So you can see governments even do not have perfect grading scores. United Kingdom, we would think, is a very dominant country, strong economy, strong global geopolitical status, strong currency, very stable currency, AA. Third highest grade, not even the highest, not even the second highest. China, A. Now we're starting to get into the middle of the pack. We're not down to junk grade just yet, but we're working our way down. So depending on who you look at, they either have an A or an A+ grade. I wanted to throw some other countries in here. Portugal, for example, much smaller geopolitical status, BBB+. Getting down into the lower medium grade of bond rates. Now, let's start going into some junk bonds. And let's talk about the junk grades. Bed Bath & Beyond, a company that has been going through a lot of trouble the past few months and years. They have been struggling with their future outlook. They have been closing stores left and right. They have a CCC- grade. If we go back to our table, CCC- puts us in default with little prospect for recovery. That is the waiting room to be 6 feet under. So Bed Bath & Beyond does not have a good credit rating. In fact, their credit rating says that they are currently in default. Little chance that they make it out. Now, there was a company that we talked about last year because they were at risk of defaulting on many of their debts. They are one of the largest real estate companies in China, Evergrande. Not Ever Given, that was the big ship that got stuck in the Suez Canal. Not Evergreen, the shipping company. Evergrande, the real estate company. They had a C rating. They have now been downgraded beyond in default to a restricted category. That means they defaulted, they failed to pay back their debts, and because of that, they have been delisted as a security that you can invest in. So they managed to fall off the entire bottom of this chart. This gives you an idea of scope. There are companies and governments on all levels of this scale. Just because a country is huge and dominant doesn't mean it's going to have a perfect rating. Just because a company is a Fortune 500 company, one of the biggest in the world, if not the biggest in the world, does not mean they have a perfect rating. As we see here, only 2 S&P 500 companies have perfect corporate ratings. Everyone else is close, but not there. So let's talk about now what happens if a company defaults. Well, interestingly, this is pretty similar to what happens when we default. A company can declare bankruptcy and file for restructuring. Basically what this means, they admit that they cannot pay back their debts. They enter a period of bankruptcy, which means that they now have to start rebuilding the company, taking pieces apart and selling those pieces to pay back some or most of their debts. So this is a very common process that will happen for people and for companies. And in addition to the hardship of needing to sell off pieces of your company or things that you own to pay back your debts, this also makes it really, really difficult, if not impossible, for that company or person to borrow money in the future. The reality of it is, company defaults are not uncommon. They happen very frequently. For bigger companies, not as frequently, but there are some, Blockbuster, I'm looking at you, that it happens to. Bed Bath & Beyond is not far off of going the way of Blockbuster. But how about countries? Have countries defaulted? And instead of just looking at countries like Zimbabwe that have had inflation issues out of control, or Venezuela that has an economy that is out of control, what about the US? We would like to think that the US is really stable. We put a lot of faith in Uncle Sam. Has he ever let us down? Yeah, 4 times in fact. 4 times in the past 160 years, Uncle Sam has defaulted on his debts. Starting in 1862, federal government defaulted because they were trying to pay reparations and damages from the Civil War and pay back not just reparations on behalf of the Confederacy, but repairing the damage, rebuilding the economy that was damaged through the war. Then we have 1933, bless you, the middle of the Great Depression. The US defaulted on its gold bonds. They had a number of securities, debt securities, that they promised they would pay back with gold. They didn't. They tried paying it back with dollar bills instead. People didn't like that. They took it all the way to the Supreme Court, and the Supreme Court said they don't need to honor it. So technically, they defaulted, even though they didn't have to restructure as a result. 1968, though, was a little bit more of a clear case. The US, and I've talked about this specific bill in the past, a silver certificate bill. This was a greenback, which is the name for the US currency. It is a greenback paper currency that, if redeemed, has to be exchanged for silver dollars. The value of that currency in silver. The US government said, "No, we're good. We're not going to do that." They stopped honoring silver certificate dollar bills and bills in general, defaulting on their guarantee that those bills would have equal value in silver. Then, the last one was 1971, where the US refused to redeem currency held by foreign governments for gold. This was not a case of domestic default, this was a case of international default. Other governments were holding US currency with a guarantee that that currency could be exchanged for equal value of gold. The US said, "Now we're good. We're not going to honor that." So technically, that's defaulting. They had debts that they refused to pay. The reality of it is, though, the US is still here. The US has not gone bankrupt. And most importantly, the US dollar is still the standard, is still the most widely used currency for international trade. It is the strongest currency in the world. Despite having a couple of hiccups along the way. Does Home Depot have a good credit rating? I don't know. Let's find out together, and I'll show you how we can do that. Home Depot, credit rating. We can find, this is Fitch's website. Fitch has their rating as A, with their current action as under review or no action. That doesn't mean much to us right now. So, they have an A rating. Let's go back to our quick table. A puts them in the middle of upper medium grade. Anytime you're curious about the rating of a company or a country, Google the name of the company, credit rating, and it's going to be the first results that pop up. Oh, if you want the link, there's the link for that. So is it stable? Yeah, it's stable. It's not perfect, but it's pretty stable. Now, why am I talking about all of this? Why does this matter today? Well, because of what happened last Tuesday. Last Tuesday, Fitch, one of those big three bureaus, downgraded the U.S. Oh, this is going to be a sentence. Downgraded the U.S. government's long-term foreign currency IDR, or issuer default rating. Ignore all of the big words. They downgraded the U.S. government. We can end it there. They downgraded the U.S. government from AAA rating to AA+. That's it. Ignore the big words, ignore IDR, ignore long-term foreign currency, doesn't matter. All of that is saying that this is the rating of the US government. It got downgraded from AAA to AA+. That is big news. This isn't just out of nowhere, by the way. They warned that they are potentially going to downgrade the US. But they did. Things didn't change, and for many reasons, Fitch decided to downgrade the US. And obviously, that's not going to make for great news in the stock market. Stock market opened, because this news came out super early in the morning. Market opened, tanked instantly with over 1% loss, and it's recovered since, but the ripples of it are still being felt. This is a big announcement, not just because of the downgrade, but the included report along with it. So let's look at this a little bit more. I want to answer a lot of questions that you, and also I, had. How bad is this news? Should we care? And has the US been downgraded before? Let's answer them. By the way, the reason that all of these questions exist is when this whole thing happened, I had the same questions. This is not something that you see in IBD every single week. This is something that happens very infrequently, and when it happens, we instantly get worried. Seeing that the US's likelihood of paying back its debts got decreased is a scary idea. Let's put it into context. Let's talk about how worried we should actually be. So, first, what was in their report? In their report, they talked about, by the way, I want to provide a copy of this report, so if you are interested, you can read the entire report for yourself. Emelida is saying it occurred in 2011. Yes, it did, and we'll talk about that here in a moment. But that wasn't Fitch. Fitch wasn't the one that downgraded them in 2011. We'll come back to that. But I just posted a copy of the Fitch downgrade report. Here are some of the big takeaways from that report. Fitch said that they are concerned about the debt limit. Remember a couple of months ago, the debt ceiling issues that we had? Yeah, they were talking about that. They said that that is a big concern, and the fact that we are having last-minute resolutions to major financial issues is a bad sign. We have a lack of medium-term fiscal framework. Basically, our medium-term plan for finances and budgeting and spending are terrible. If you remember the resolution from the debt ceiling limit, it was to freeze any of the concerns or worries until 2025. It wasn't a resolution. It wasn't a cutback of spending or an increase in taxes. It was, well, we'll talk about it 2 years from now. That's not a good thing. That does not give credit agencies a lot of confidence. So, they quoted a lack of medium-term fiscal framework. Tax cuts and spending initiatives. Those have been terrible. The US government needs to raise more money, so how do they raise more money? They cut taxes for the rich. They increase government spending. How is that going to fix the problem that we're spending too much money right now? It doesn't, and that's why they said it. This was an issue. So it's increasing our federal debt. Also, we have an increasing general government or GG deficit. This is the generalized spending of the US government on infrastructure, development, defense, and all of the other branches that the government serves. So we are running a larger deficit, meaning we're not making as much money as we're spending. And the amount that we are in a deficit is increasing. They also said that the Federal Reserve continues to increase the federal funds rate. This will put additional pressure on the economy, and they expect, Fitch expects an increase of the federal fund rate of 0.25% come September, seeing the rate go from 5.5 to 5.75%. So all of this is not great news, but here was the big one. You're probably getting sick of me talking about this, but the big point of this article was the fact that Fitch predicts a mild recession of the US economy in quarter 3 of 2023 into quarter 1 of 2024. That is big news. I have come on here and I've talked about many times. Do I think we're going to be in a recession? No. Do I think that we are moving out of a recession or economic pullback? Yes. This contrasts that. This is saying we aren't in a recession and we are about to be in one. That is why the market freaked out. But was it all bad news? Did Fitch only have doom on its mind come Tuesday? No. There were a number of good things that they said in there too. They noted that there was a number of positives within the US government, including that we are still a large, advanced, well-diversified, and high-income economy. We have a well-established record of rights for our political process, institutional capacity, and effective rule of law with low levels of corruption. And finally, that there is a clear path towards a rating upgrade that includes lower government debt and better fiscal planning. This isn't you need to hit rock bottom before you can pull yourself back up. This isn't the US government is on a disaster path. This was we are worried about the short to midterm outlook of the US. The US isn't doing anything about it, so This is us saying something needs to be done, or else we're going to continue downgrading. Now, that's the big news. Now you know what it is, you know the bad and the good. Let's talk about why it matters, and if it matters. And let's start doing that by asking some questions. Will this downgrade have a long-term effect on the stock market? Probably not. I don't say no, I say probably not. The reality of it is, AA+ is an extremely high rating. I don't think any of us need to worry about Apple going bankrupt or failing to pay back its debts tomorrow, and Apple has an AA+ rating. They did not point to a severe recession or an economic depression in the coming months and years. They said that they forecast a mild recession, and that recession will only last 2 quarters. And, as Emelida very intelligently pointed out, they're not the first downgrade of the US. Remember how I said there was the big 3 credit bureaus? Moody, Standard & Poor's, and Fitch? Well, Fitch is kind of just copying Standard & Poor's work from 12 years ago. In 2011, citing economic division in our government, spending and tax divides, oh that sounds familiar, and many other fiscal issues, Standard & Poor's downgraded the US from AAA to AA+. So, this was not shocking news. This was not the beginning of the end for the US Treasury Department and the US securities market. We've been there for 12 years. If you want to talk about our perfect credit being broken, yeah, that ship sailed 12 years ago when Standard & Poor's downgraded the US to AA+. So, it's not too bad. It's not great, but it's not terrible. And the reality of it is, it's probably not going to have a lasting effect on the stock market. This is where I ended this presentation last week. This is where the end of it would have been. Until today. Last week's downgrade of the US was not the end of this story. This week, and by this week I mean literally today, which is August 8th of 2023, the other credit bureau, Moody's, did not cut the US, so don't worry. Moody's cut the rating of 12 regional US banks. Moody's cited issues with the current trend in federal interest rates, asset liability management, so basically how much risk these banks are taking on, as the reason for their downgrades. In total, again, there were 10 banks that were downgraded, and for sake of completeness, here is that list. Commerce Bankshares, BOK Financial, M&T Bank, Old National Bancorp, Prosperity Bankshares, Amarillo National Bancorp, Webster, Fulton, Pinnacle, and Associated Bancorp. All 5 of these banks had their credit ratings downgraded. I'm not going to go through each individual one and say what it went from and what it went to. If you're interested, you can read each company's downgrade report over on Moody's website. In addition to providing ratings, each of these organizations provides their outlook. So basically, what are they thinking about? Are they thinking it's going to get better, or are they thinking it's going to get worse? They say that by stable, increasing, or positive, or decreasing, negative. So if a bank or if an institution has a negative outlook, that means that they might be next to get downgraded. It is the list of companies or organizations that are at risk of being downgraded if things don't improve. To give you an idea, the US was put on watch twice by Fitch in the past few years. First was in 2021, I believe, and then the second one was in May of this year. So, in addition to the 10 banks that were downgraded by Moody's, there were 11 banks that were given negative outlooks, at risk of being downgraded in the near future. This is the more important list because there's probably some banks on here you either are familiar with or you might even bank with. PNC Financial Services, Capital One Financial, Citizens Financial, Fifth Third Bancorp, Huntington Bancshares, Cadence Bank, F&B Corporation, Simmons First National, Ally Financial, Bank OZK, and Regions Financial. These are the 11 banks that were not downgraded, but were put on watch with negative outlooks. This is pointing to a bigger issue within the financial sector. This is saying that we are worried about the health of the financial market and that this is something that we should be paying more attention to. There are issues that aren't being addressed, and as a result, because they don't see forward progress, they are slashing their ratings and being a little bit more worried about where the financial industry is headed from here. So if they're worried, should we be worried? Again, I will give the same answer. No. Or, kind of no. My answer is no, but this is a little bit more worrying. We aren't surprised, by the way, because this should be a little bit familiar. We saw 3 banks run into issues and have to be bailed out a couple months ago, back in March. We saw 3 banks that ran into issues and needed to have the Federal Reserve step in to resolve those issues. So one of the key areas of concern for Moody's was in the risk management, especially within the corporate real estate market. Many of these banks, these regional banks, handle finances and lending for corporations. And within corporate real estate, because real estate prices are finally starting to be impacted, Moody's is worried that a breakdown of the corporate real estate market will negatively impact these financial institutions as well. Unsurprisingly, this news had an immediate short-term impact on the stock market. If you watched the stock market today, it opened up down. SPY opened up down over 1%. XLF opened down 1.7%. While the markets did trend upward throughout the day, it still is a step backwards in terms of the progress that we've seen in the market over the past few months. But just like the start of the banking crisis in March, by the way, when I say this too will likely blow over, I don't mean the banking crisis and the challenges surrounding banks. I am not a financial auditor. I have not dug through all of the balance sheets and risk portfolios of these banks. I'm not going to comment on the financial stability of banks. I'm going to comment on the market. The market is going to move on very quickly. It moved on very quickly in March, and don't take my word for it. Let's ask some other investors. Have these announcements affected investor confidence? We don't have the whole story yet, is the answer. We do know about last week's announcement. We know how the market responded to the announcement that Fitch downgraded the US government. Despite the week being a down week in the market, with the majority of sectors losing value, investor confidence rose almost 4%, from 44.9% to 49.0%. And at the same time, bearish sentiment, the feelings of negativity in the market, decreased from 24.1% to 21.3%. This is the lowest value that we have seen bearish sentiment since June of 2021. That is not the sign of investors worrying or tightening up. That is a sign that investors are getting more confident in the direction of the stock market. Again, investors focus mostly on the stock market because the stock market leads the economy. Now, if we want to know what happened today, I can't give you any specific details, but what I can say is that stock futures and options showed very little change. What that means is that investors aren't really worried about where the stock market's going to go from here. Yes, most indices dropped today, but stock futures did not. Stock futures are still very stable, indicating that most investors think that this is going to blow over fairly quickly. So that's investor confidence. And investor confidence is mostly unchanged. So how about bond markets? If we're talking today a lot about credit agencies and bonds, how's the bond market been doing? Well, here's kind of where my answers have to end, because the last update that we have to the Corporate Bond Distress Index, or CMDI, was from July 1st of 2023. We do not know yet how last week's events or today's events will impact bond distress. But to give you an idea of where we were on July 21st, and know that I'll be here to talk about it when we get the new updated numbers for August, CMDI found that volatility within investment-grade bonds, hey, we know that term now, is still pretty high. We are currently sitting around the 70th percentile, which is well above the normal values. Junk bond distress remains fairly low, around the 20th percentile. So this is saying that junk bonds are largely unaffected with what's going on right now, and instead, investment-grade bonds, these large corporations with strong credit ratings, they are the ones that are experiencing the most change. So, that's a lot of information. That is a lot of economic data. That is a lot of speculation. Where do we go from here? Let's bring things back. Let's come back down to earth, and let's talk about you, me, and Juan de los Valores. Where do we go from here? How do we use this information to invest? In my opinion, nowhere. Not much needs to change. These downgrades are important to be aware of. They shaped the market last week. They shaped the market today. I'm covering all of this because this is something that does not happen every day, and it is a great way for us to understand the securities market, another side of the securities market, in context of current events that are happening right now as we talk about these events. The reality of it is, though, there will be in my opinion, there will be little to no mid to long-term impact from the downgrade. The biggest part of that report, to me, was the forecast of a mild recession beginning in quarter 4 of 2023, moving into quarter 1 of 2024. I didn't worry about the bond ratings changing or the security rating changing. I got very focused when I saw that they said that a recession is coming, because that is in direct contrast to both the FOMC, to national bureaus, and to independent forecasters as well. They might know something we don't, or they might be looking a little bit more broadly than we are. Whatever the reason is, they are forecasting something that no one else is really forecasting. So, in contrast to many of the key economic indicators of recessions, things like we still have fairly low unemployment, Our interest rates are dropping, and the FOMC's forecasts for GDP as well as company earnings from FactSet are all positive. This was a very interesting take. This was a very interesting perspective. And just remember, nobody knows the whole story. Fitch is not perfect. Their job is to manage and understand risk. They will plan for the risky scenarios because no one's going to get too mad if there isn't a recession. People are going to get really mad if we are predicting only growth and then we fall into a recession. I think that it was a very interesting perspective, that it could happen, but a lot will have to change between now. Well, a lot's going to have to change, and nothing is going to have to change in terms of policy if we are to see that forecast actually come true. Again, that is simply my opinion. What I wanted to do today was offer you this data, offer you the knowledge of what is going on, the awareness of what is going on, so you can make your own decision as well. So to help us do that, let's summarize everything that we learned about today. We talked about companies and governments and how they are given credit ratings by many agencies, including 3 major ones. For consumers, it is Experian, TransUnion, and Equifax. For companies and governments, it is Moody's, Standard & Poor's, and Fitch. Last week, Fitch joined the S&P, Standard & Poor's, who in 2011 downgraded the U.S. credit rating, the U.S.'s credit rating from AAA to AA+. And additionally, today, August 8th, Moody's downgraded 10 different regional banks. They downgraded their credit ratings, with 11 banks having their outlooks changed to negative, with potential for further downgrades in the near future. While these events make for some really good headlines in the news, in my opinion, there's likely little to worry about mid to long term. To me, the biggest announcement from today, or from this week, was the forecast that the U.S. will enter a mild recession towards the end of the year. The reality is, though, I can't know for sure, the FOMC can't know for sure, and even Fitch can't know for sure. No one has the magic crystal ball, and whether we see that recession or not, only time will tell. This agency is monitored by the federal government. No. They are independent organizations. The government has no influence over Moody's, Standard & Poor's, or Fitch. So they are very non-biased. So, that's credit rating agencies. That's what changed with the U.S. credit rating, and banks as well. There is a lot for us to unpack here, and unfortunately, there are more questions that we will have than we will get answers. But hopefully today, I've been able to give you a better understanding and more awareness of things that are happening in the investment and the financial space, shared with you some new knowledge and some new learnings, and hopefully brought it all back home to explain to you why we should care, but shouldn't worry about all of the news that's going on. Thank you all so much for joining us today. If you have ideas or topics that you would like to see us covered in a future webinar, you can always send us an email at support@sectorsmadesimple.com. Thank you all so much. We look forward to seeing you back here for next Tuesday's webinar and for SM Espanol this Thursday. Thank you all so much. Take care. Have a great afternoon.